Good day there, Wealth Press subscribers, viewers, investors, and traders. Welcome to yet another Monday morning roundtable. My guests today are Roger Scott, Jeff Yasteen, and Adam Sarhan, and Zeph Zananiri. Good morning, gentlemen.
Hey, good morning.
So we kick off the day with the S&P once again in record territory. This broken record is becoming somewhat predictable. Price of oil stable at $42. The Dow flirting with new highs. It's just more of the same, isn't it? We just keep on moving higher. Roger, let's start with you. Give me an overview of what you think we should be expecting this week.
Well, this week is going to be an interesting week because we have the GDP on Thursday, and the GDP is expected to be down in the 30 percentile range, which is just, you know, to give you a perspective, positive 2%, negative 30%, huge difference. But what is positive is retail sales are really going through the roof, and that is going to reflect substantially on the GDP. We're also going to have consumer confidence tomorrow. If that's positive, we may have a much better than expected. I personally think the GDP number is just really a pessimistic level right now, and I think there's only upside from here. But usually when we have a GDP on Thursday, we usually see a subdued week leading into the GDP, especially if the Fed talks before that. And I believe we are going to see the Fed talk on Wednesday. So we got GDP on Thursday and we have jobless claims. And I think we're going to see the majority of the trading action fall towards the second part of the week as a result of that. Okay.
Jeff Zananiri, what's your sort of 50,000 foot view of the week?
Good morning, gentlemen. So we've seen an extension of a little bit of the insanity in the premium paid for some of these tech stocks. And I've been kind of a proponent of seeing things getting kind of stupid on the upside, like a capitulation of people panicking to own these stocks that is starting to come to reality. What concerns me is you're still seeing some weakness and sagginess in banks and sectors like that I'd like to see some more oomph out of. I mean, if there is a value area that I would try a little bit, that I have been trying and nibbling a little bit at, it's the banks, because I think that the scenario that I've given where there's value traps, that is, there's companies that might not need to be around in the new reality. You can't say the same thing about banks. A lot of those banks are also too big to fail, especially in this country. So I'm looking at the price action in the banks. I'm looking for a little bit of a blow off top in the Teslas and the Apples of the world. And I think it could all happen this week. I think if you see a little bit of a rotation, you're going to see it come into the banks, but keep your eye on the blow off top in the QQQ. So it's kind of a slow week. It's a weird week. It's the last, the last full trading week of August. And usually seasonably, this is like one of the slowest trading weeks of the year. So we'll see what happens. There's interesting price action, but it's not a lot in terms of like news catalysts. I mean, there's news, but like event catalysts, I should say.
Sure. Adam, how are you looking at the week ahead?
Sure. So I concur. I agree with what Roger and Jeff Z both just said. I'm also looking from a political standpoint. We've got the Republican convention. Yesterday, Sunday night, not a normal routinely thing, but the White House came out at 5:30 Eastern and said, hey, we have a potential plasma green light the situation. We're going to take antibodies from people that already have COVID and recovered. And that's a big boost that helped futures soar once futures open half an hour later. It wasn't a coincidence, the timing of the news announcement. And we want to see Trump is going to be speaking every single day at the convention, which is a very Trump-esque type move to take the spotlight, take the attention. And that's a good thing. And this is not it's not a political statement right or left. It's just he's doing what his job is, and that's get attention and stay in the front lines and stay front and center on people's minds. And the market so far is rewarding him very handsomely for that. So you've got a situation where we want to see the outcome of the convention. We want to see if there's any major news events up or down from the convention. And then we have a bunch of earnings also coming out this week, but they have tapered off a lot. And then you have the GDP that Roger mentioned, the consumer confidence, a few other things as well. So we want to put all those pieces together and see where we end the week. I do feel the market is very extended and we are way overdue to pull back. Doesn't mean that you have to sell everything, go to cash right now, You can trim your positions. You can do whatever you want. You're free to, obviously, your own situation. This is just general, more or less observations. But the idea is just to make sure you have a plan for when the market does pull back now, before it pulls back, so you're prepared for that inevitable pullback and you don't panic like everybody else.
Sure. And finally, Jeff Yasteen, what are you focused on this week?
Well, I like what Jeff said earlier about watching the banks, and they've been the laggards. There hasn't really been much happening, but then again, they haven't gone down either. I would look for activity there. One area that I really like and starting to pick up here is like this morning, we have the airlines, Delta, American, Allegiant, which is a carrier I like. They're all up 3, 4, 5%, and they've been basing since early July. Again, is that the vaccine, coronavirus, end of this particular phase of the pandemic? I'm not sure. Or is it just the beginning of a rotation out of these higher price names like Jeff and Adam were talking about into ones that could have some traction going forward? I'm not sure yet, but I like where all this is going, and I would watch those, especially since they tend to be more economically sensitive and again, sort of positioned towards leisure and those sorts of things, which nobody's wanted to touch. It's been dead money for since February, essentially.
Sure. Okay, so let's talk about this idea of a blow off top, which is by unanimous decision, long overdue. And like I look at Tesla. Tesla broke $2,000 on Friday. It was $1,500 2 weeks ago, and it was touched $1,000 for the first time 3 months ago. And it just boggles the imagination in terms of fundamental justification for why Tesla should command such a valuation. And so I look at the idea of an anticipated corrective phase in the market, and I think that, well, okay, I'm looking at Tesla's down 3.71%. Is that the extent of the corrections we can expect these days, now that we are so liquid with all of this quantitative easing at the hands of the central banks? And that's kind of an open-ended non-question, but let's see how you can deal with that, Jeff Zaninieri.
So Tesla, I used to hire and train young traders. And for about 2 years now, Tesla's been, for me, a no-touch stock. So that's to say, if I had a junior trader on the desk and he put a position in Tesla one way or the other, I'd probably be pissed off about it, because it's kind of turned into a cartoon stock. If he was short Tesla, I'd definitely be pissed off about it, because as you can see, the risk reward is horrific. And even though the thesis is tight and good, it's still something you don't touch, because if you don't understand something, if there's an unpredictability factor about it, you shouldn't be playing in it. There's a lot easier ways to make money on things that make sense, on things that we can predict. And that's how, as a professional trader, you're schooled, you're trained to think. Now, what do I think about Tesla as a blow-off indicator? I think it's a good blow-off indicator. I think cryptos are a good indicator of froth. I watch the cryptos a lot. It's weird. I watched them over the weekend, and I saw that there was a little bit of sagginess in Bitcoin, which isn't something I trade, but I use it as an indicator. So what I would say is you should have a really tight plan for what you put your money into. You should know the difference between your trades and your investments. And you should learn to use things that you don't necessarily put money into as indicators for the other stuff you're going to do. I don't know if I answered you, but I said what I wanted to say anyways.
Well, it's really a subjective sort of contemplation, really, when we're trying to, what are the factors that are going to actually induce a broader market correction like we had back in March. And Adam, do you have any input for that?
Yeah, I have a lot to say about Tesla. So first, full disclosure, I'm long and members are long for a long time. We've done fantastic. We're up over 200% in the stock. So that being said, let me break down Tesla a few different ways. Number one, they're a forward-looking company. They're revolutionizing, completely disrupting the way people drive cars. I don't know if anybody's had the chance to drive a self-driven Tesla, but the experience is absolutely fantastic. And not only are they a car company, which people are forgetting, they also are Solar City. They're a solar play. And if you look at the ETF TAN, TAN, it's an ETF that tracks solar stocks. You know, every week I go through hundreds of sectors in the market and I rank them based on their performance. And the automobile manufacturers, thanks in part to Tesla, and are number one or number one-ish for the last several weeks. And then number two below that, and these are industry groups, they're not sectors. Like, you know, there's sectors and then there's industry groups within each sector. And then number two, right behind that, are the solar stocks or the alternative energy plays. And if you look at them, they're fantastic. A lot of these guys are acting extremely well and nobody's talking about them. So Tesla benefits from those two major factors, that it's a solar play, you know, an alternative energy play, but it's also a car company that's disrupting the way fundamentally people are going to drive cars in the next 3 to 5, 10 years. Talk about the Robinhood traders, the millennials or Gen Zs or whatever it is. They look at you pumping gas as if you're a dinosaur. Why would you do that? It's almost like somebody going back and putting a tape, I gave a young kid a Walkman, one of my old Walkmans from the 90s, and he looked at it and he didn't know how to use it. And he looked at me like I'm bonkers. Why would you ever use something so antiquated? I remember 8-tracks even before that. So, you know, it's just one of those things where it's a perspective and the company's able to look forward. So investors are, yes, they're paying up for growth, number one. Number two, the company is believed to enter the S&P 500. If that happens, you get a whole nother wave of buying come in. And then also, on top of all those factors, there aren't really that many companies out there, including Apple, which is also in that extremely strong momentum type driven environment, that have that kind of innovation occurring, which is fundamentally changing the way consumers experience or consume a product. In this case, it's changing the way consumers are driving cars. You know, back when Steve Jobs was alive, and, you know, rest his soul, God rest his soul, he had an innovative machine. When he invented iTunes, it killed the Walkman. And then years later, he came out with the whole, you know, disrupt the music industry. Sell a song for $1.99, and it crushed it. And then he had the App Store. Then he came out with the iPhone and then the iPad, so on and so forth. And the company was constantly innovating and fundamentally just changing the way things people lived and consumed. And you know, since Tim Cook took over, they've generated, I think it was $2 trillion in sales. Not only their market cap dropped $2 trillion, but they've also generated a ton of money. But the point is, they haven't really innovated. But Tesla continues to innovate. I think that's why investors are really paying up for that innovation, because the market doesn't really have a lot of that.
Okay, Jeff Yasteen, maybe Tesla's not such a good company to watch for the to represent the broader market in the search for the blow off top. But what do you think might catalyze that sort of correction?
Well, look at like with chips. I mean, NVIDIA is something I recommended when I worked for another operation at the beginning of this year. And of course, it's done fantastic. It's what, doubled or gone up to 150%, 200% since January. I'm not sure that chart wise that it really looks like it's topping out. I think it could continue to go further. But, you know, if you just look at the sort of the just general absolute bullishness to the point where, let's suppose next week or 2 weeks after that, we get a correction, and everybody who's talking about, who's inexperienced, let me put it that way, who's saying, hey, if I miss my chance, I'm going to buy here. If that's sort of the attitude, sentiment wise, you know, I think we could see more downside than we might otherwise expect, simply because people are so amped up and so bullish. So I feel like we're getting really close here. I'm just echoing what I know Jeff Z said earlier, but I really do feel like we're close. Is it the top, you know, some sort of gigantic, you know, blow off top? I'm not completely sure on that, because I think we're going to see some rotation into these other sectors that have been falling far, far behind. But at some point, you know, beyond that, I think there is a chance of that. So you just got to watch these, as was it you were saying earlier, the kind of these crazy, stupid things. You know, think back to, and I know I'm going to get in trouble here for making a comparison to the dot-coms, but I think of like Yahoo or AOL, which were, you know, companies that were, you know, certainly got their share of promotion in that time frame, that generated profits, and yet they just got blown way out of proportion value-wise to what they were earning in profits. And that's where the trouble begins, because you think that they're going to continue to earn and be valued at that level. And at some point, you know, somebody somewhere on Wall Street says, hey, maybe we won't pay 80 times or 100 times earnings to own this stock. And that's where the backtracking, that's where the trouble begins for the people who are buying at the top at that point of maximum optimism.
Matt Phillips in the New York Times published an article on the weekend suggesting that the era of the idea of debt being a natural negative impact on economics generally and the markets indirectly, that era has now passed. And this idea that governments can, in fact, launch nonstop deficits that only grow larger over time and are passed down from generation to generation. I was in shock when I read this, and but I thought this is actually consistent with what seems to be happening in the market. It's like nobody has a care in the world. Chicken Little has been assassinated once and for all. There is never going to be another downturn in the market. Stocks are going up forever. And it seems like if you try to make any rational argument based on fundamentals against that, people just laugh at you. And it's like, you know, Adam, you did a great example. Tesla's got so much runway ahead of it yet Jeff's argument as well makes perfect sense to me. I would kill anybody who went long. I would kill anybody who went short. I feel like I've missed the boat tremendously because at $800 I thought it was a short. So it's like rational minds need not apply. Adam, you look like you have a comment for that.
Yeah, I was going to say that's a really, really, really good point. And if you go back and study history, you know, I've studied every major bull and bear market since the 3rd century. And if you look at it, even Sir Isaac Newton got stuck into that South Sea bubble back in when he was alive. The tulip bubble in Holland, the 1920s, the roaring 20s, and the 29 crash, the late 90s. This is reminiscent of what we've seen happen over and over and over again. And it's the basis of what I do is I just study human nature, psychology, and its behavior. It's fear and greed that drives markets. When you get a situation like that, where you just described, Jeff, where people are throwing caution out the wind and they're laughing at you, that's usually a sign of a top. Remember, we've been rallying since 2009. That's 11, almost 12 years now of just a little over 12 years, of just nonstop rallying with a few blips in between, the 30% correction in March and a few other, you know, deep corrections, but that were short-lived. Now, if you go back to 98, the last, you know, that last big, huge blow off top, the market rallied more or less for almost all of the 90s, right? You had a savings and loans crisis in the early 90s. Then you had the Asian financial crisis and long-term capital management failed in 98. And then the market just took off and then it went absolutely bonkers and then it crashed. So what we're seeing now, that euphoria, that absolute, you know, irrational exuberance, if you will, whatever words you want to use to describe this manic buying, that you almost, not usually, that always ends in tears.
All right, Roger. So what is going to signify, what is going to take the market in the other direction?
Momentum. It's always the same thing, momentum. And I'm seeing a lot of cracks in the foundation right now. For example, we have been seeing nothing but narrowing of momentum, which means there's less stocks propelling the market higher. To give you an example, the momentum peaked June 8th. When the stock market, when the NASDAQ was about 15% below the current value. There was 85% of 88 stocks out of 100 and NASDAQ 100 causing the market to rally. Right now, there's 12% less stocks and the market is about 15% higher. So we are not firing off on all cylinders. A similar pattern is happening in the S&P. The put to call ratio is heavily weighting towards the calls right now. There is a huge increase in put buying. There is divergence right now between the South Korean NASDAQ, the same NASDAQ that we have here, that they trade on the NASDAQ exchange. I mean, that they trade in Korea. Huge divergence between the NASDAQ tech in Korea, in South Korea, versus the NASDAQ and the US exchange. And I'm going to be doing a long video for your channel and after we're done with this broadcast, and I'll talk more about that then. But there is a lot of things happening that are pointing. There's divergence between the RSI, a long-term divergence between the RSI and the trend line. There are tons of things that are pointing to a correction. The question is how deep the correction will be and how long it could be. It could be a 5-10% correction, or it could be a 30% correction. And that we won't know till we get into it. But there are a lot of signs pointing to a top right now. Long-term top, medium-term top, short-term top, too hard to tell right now, especially with the influx of capital coming into the economy right now. But there is a storm brewing on the horizon. There is absolutely no question of that.
Sure. Okay. So, I mean, would you consider the VIX a leading indicator or a more trailing indicator of market sentiment?
I would consider it more of a neutral here today now indicator, if you want to know the truth, because
utterly useless.
Yeah, because well, it has some longer term effect, but not too much. I mean, in other words, very short term impact, maybe between now and end of the day. Because keep in mind, the VIX is based on a 30-day forward movement, and usually it's looking at the money options on the S&P. So it's literally the instant reaction to what the market is seeing in real time. It's literally the implied you're looking at an implied volatility. Basically, the VIX is a reflection of the implied volatility on the S&P based on this current sentiment level right now. So yes, while it's taking everything into account in the future, it's still based on today right now, and it has only a 30-day look forward. So it is very limited. And if you look at the VIX, it's still, I mean, if we did not go through this COVID-19 correction that we saw in February, and if you looked at the VIX, you would think the VIX is in panic mode right now. But based on where it has been since February, traders are looking at it and it's looking a little cooler. But where is the VIX? It's still above 20, I imagine. Anything above 20 is danger zone.
Sure, it's 35 right now.
35. Okay, so yeah, I remember it was just
23.
I have 23.
Yeah.
You have 20. What am I looking at here?
It's above 20, right? It's
23.
Yeah.
Okay. So anything above 20 is telling us.
I have it on the Bloomberg right now.
Anything above 20 is telling us that the market is in danger zone. It's always been that way. 30s panic, anything above 20 is danger zone. And it's been above 20 since February. So
can I interject on the VIX?
Yeah.
Sorry?
So
go ahead.
Can I interject on the VIX?
Please.
Sure.
What people don't understand about the VIX, and this is constantly a misrepresentation in the financial media, is that it's strictly an indication of if the market is bearish or bullish. That's not true. What the VIX is telling you is the expected range of the move of the S&P 500. So at 23%, at 23, we're expecting the next 12 months to be a 23% move up or down from this level. And so when we're having super bullish moves, you can still be at a high VIX because of the range of the moves, the expectation that stocks are going to move a lot higher or a lot lower. They're not going to move muted. So pre-COVID, when we were in a super low VIX era, we were at like 10 VIX. Your daily moves on stocks were like 20 basis points. The S&P moved like 5 basis points a day. It was just like this slow trudge. So we're going to stay, in my opinion, in a higher VIX regime because of the nature of how much we've run up and how much we ran down. And that doesn't just like flip. That's a regime that stays with you. That just doesn't turn off like that. Sorry to interrupt, Roger, but it's something I thought might be valuable for people to understand.
It's very valuable. And with that said, and Jeff is absolutely right, and that's how it works. The problem with that is that 99 out of 100 times, or 90 out of 100 times, you will see that higher volatility when the market goes down instead of going higher. It doesn't happen that often, but yeah, on a technical basis, it measures the movement, the expected movement, and the extended range.
Okay. So the chart I'm looking at is the S&P 500 VIX short-term futures, SPCFD, and it indicates a future September price of 35. So does that mean that there's an expectation on the part of futures traders in the VIX that the volatility range is going to go higher?
I'm looking at the VIX, actual VIX, the volatility index at the CBOE. The CBOE has an index called the VIX, and it's at 2292. So each month of a future will have a different price. So what that's saying is next month they expect to ramp up in the volatility next month.
Right.
In September. September is historically a more volatile month.
Sure.
But as we sit here now, the VIX is at 2280, 23.
Sure.
Usually the ticker symbol for that, for those listening at home, is usually $VIX.
Right.
Typically, or some form of VIX. Maybe
so then we'll categorize the VIX itself as a intra-period indicator, more or less. The futures is a derivative of the derivative, is basically a casino off the main drag, I guess is the best way to categorize it. So let's talk about gold and the interest rates then. We got the 10-year stable at 62.62 since May, more or less. And gold has now sort of started to tread water in a very tight range between 1930 and 1970. And so that kind of makes sense to me, because with the S&P firing on all cylinders and reaching into new heights, why would you panic and start to, increase exposure to gold? Yet, if all of this is indicative of a even more pronounced correction at some point in the future, shouldn't gold still be rallying? And interest rates, I guess, are not really capable of moving, given the Fed's position that they're not going to do anything, especially with an election coming up. So really, it looks like, if I was a betting man, I'd say it looks like the tape has been painted in such a way to encourage me to continue to step up to the casino and wager my money on U.S. techs and nothing else but. So how does that kind of mentality protect itself against this invisible top on the timeline?
I think you have to look at the quality of the money that's moving into the gold market. First of all, there's very little incentive right now for investors to stay in the US dollar. There's very little incentive for investors to stay in the bond market. Historically, you don't see such a low yield on both the dollar and the bond market, and with gold and precious metals rising. Also, I think that the world is very divided right now on where to invest. I think a lot of people are very fearful that the stock market, a lot of professional traders are getting more and more fearful, like Buffett started putting his money into the gold market. So I think you have a certain quality of money putting their money into the gold market. I don't think the gold market is as broadly invested as people, as the retail public believes right now. I think if you were to look at the underlying accumulation, you would see a lot more institutional buying and hedging in the gold market versus a lot more retail trading in the stock market, which we have seen. We've seen a lot more open interest on small traders moving money into the stock market. So I think what you're seeing is a longer term reaction in the gold market that is a combination of the overbought stock market, the lack of options in the US dollar, the lack of options in any, and I say options, I don't mean derivative options, I mean options in terms of investing in any broad market in terms of global economy. I think that it's the last safe horizon. I think that the way, and I'm looking at it the exact way Warren Buffett would have looked at it. He looked at the stock market, he started valuating stocks. He saw that there's absolutely nothing of value right now that's worth buying, and he moved into the gold market. So I don't think he would have done that if yield was higher. I think he would have put a lot more money into corporate yield, into government yield. And I think that the lack of choices is causing people to put more money into the precious metal market. So I think it's a matter of need and not a matter of choices. I think it's because there's lack of choices. I think that's what's kind of painting us back into the gold market.
Okay, well, let's leave it there for now, gentlemen. We've consumed a half hour with pontifications of an extraordinary, subtly genius manner, and we'll come back to each of you during the week. And have a great, fantastic week.